The Peter Schiff Show.
Well, we got some more bad economic news coming out today. And of course, it capped a week of generally worse than expected news. I was looking at a chart of the Economic Surprise Index on an article on Zero Hedge, and it was a new low for this cycle. And they went back to find the last time that the Economic Surprise Index was this low. And it was right about the time that the Federal Reserve launched Operation Twist. Remember that? I was calling it Operation Screw. It's when the Fed was lengthening the maturity of its balance sheet. It was selling some of its short-term bonds and buying longer-term bonds to have more of a direct impact on pushing down long-term interest rates. Yet today, when the market is being surprised by the same amount of negative economic data, unexpected negative news. And again, every time you read a news story that says, something was negative, it's always prefaced with that it's unexpected. And, that's why I always put it in quotes when I put those headlines on up online, because why don't they expect it by now, right? You pretty soon, you get enough bad news, you should expect it. And at some point they will. And that's when the index starts to go the other way. When things are bad enough, long enough, people start expecting bad things to happen. And then next thing you know, good things happen. And so the Economic Surprise Index goes the other way. But people are still optimistic, yet they keep being disappointed. Yet despite this, right, the Fed is not only not doing Operation Twist, it's tightening. It's putting the screws on big time in its mind, in that it has just announced quantitative tightening, right? Not only did they just raise interest rates on Wednesday, but they indicated they're getting ready to do quantitative tightening for the first time ever, right? This has never been tried before by the Federal Reserve, and they think that they could do it. It's amazing too that they will acknowledge, the Federal Reserve is always out there talking about how quantitative easing helped the economy. It pushed up asset prices, it pushed up the stock market, it pushed up the real estate market. Okay, well, if that's what they think, how can they believe they can reverse the process, do quantitative tightening, and not have a negative impact on asset prices, not have a negative impact on the economy? It's amazing that they have the hubris to actually believe that this can be accomplished. And again, it doesn't have a positive impact. You inflate an asset bubble, and the asset bubble can distort the economy and lead to phony economic growth, the appearance of economic growth. And yes, if you try to suck the air out of the bubble, that phony wealth is going to disappear, and you're going to be left with all the problems that you created when you did the artificial stimulus. And so to the extent that the Fed actually follows through with quantitative tightening, and again, they are data dependent, but who knows what that means, because again, they're ignoring all this data. But at some point, they won't be able to ignore it. The data we got today, early this morning, was housing starts, and an unexpected big drop in housing starts. This is the third month in a row that the starts are down. So I wonder whether they're going to expect it. But there was a slight revision to the prior month. But not only were housing starts way down, but building permits were also way down. So that means that this trend is likely to continue. The last time we had 3 consecutive monthly declines, it was 2009. Gee, what was going on in 2009? Oh, the greatest recession since the Great Depression. That's the last time we had 3 months like this. And, this is the lowest level of, I think, 8 months or something like that. I forget. But this is bad news on a big sector of the economy. And guess what? The Fed just hiked rates. So if housing starts were bad before the hike, aren't they going to be worse after the hike? And quantitative tightening also involves selling mortgage-backed securities. And so if the Fed is a seller of mortgage-backed securities instead of a buyer, what does that mean? That means that there's downward pressure on price, upward pressure on rates. That means it's more expensive for people to buy houses. So what does that mean? That means fewer houses are going to be built because fewer people can afford to buy the ones that have already been built, let alone adding to the supply. Housing is a big employer in the economy, a lot of construction jobs. And it's not just housing that is being impacted by rising rates. It's automobiles. I mean, the air is already coming out of that bubble, and the Fed just put another hole in it. But everybody's got debt, consumers, credit card debt. Student loans, they float too. Student loans could be moving up higher, and all these students with all this debt, they don't have a lot of extra income, the ones that are actually paying their student loans. So the Fed is just oblivious to this, although the Federal Reserves that do these, GDP forecasts, both the Atlanta Fed with its GDP Now and the New York Fed with its GDP Nowcast, they both came out and downwardly revised their estimates for Q2 GDP. The Atlanta Fed moved down from 3.2, which it just moved up to. It was at 3% on Wednesday, the day of the Fed rate hike. And the morning of the hike, or before the hike, they moved it up to 3.2, which surprised me because we got bad news, and then they went up to 3.2. But I thought maybe the optics of reducing their expectations just before the Fed hiked rates that day, based on how great the data was when it wasn't. So they waited till today, but now they revised it back down to 2.9. So it's now lower than it was on the Wednesday morning of the rate hike. But what's more important is not where the Atlanta Fed is, but the New York Fed, New York GDP Now. They went down from 2.3 to 1.9. So this is the lowest they've been this year, 1.9. 2.9 is the lowest the Atlanta Fed has been. But you still have a full percentage point between the New York Fed and the Atlanta Fed. Now, I think if this was the Price is Right, they would probably both lose because they're probably both over. And they're probably going to have to move these things down. But obviously, I think the New York Fed is closer to hitting the mark than is the Atlanta Fed. But sometimes the Atlanta Fed has a tendency of really making quick adjustments later on as we get a lot closer to the end of the quarter. They quickly ratchet it down to kind of catch up to where the data has been. I'm not really sure, why that is or what the methodology that they use, but I've seen that or I've noticed that happening in the past. But we're getting all this information. The economy is weak, and the Federal Reserve is acting as if nothing has happened. The only thing they seem to talk about is inflation, and their confidence that they're getting close to the 2% level, when I'm sure we're already well beyond that because the methodology for measuring it is incorrect. But I'm reading more articles now about raising the inflation target. This is coming, because one of the reasons they can't be too easy is because inflation is close to 2%. Now, it's the core inflation, the way they look at it, is actually starting to back away from 2% a little bit more. So there are some people who are saying, well, can't the Fed see that inflation is going down? Why don't they do something about it? But maybe with the inflation target at 2% and you're just under it, and the Fed can think of reasons that are transitory, like cell phone prices or whatever they pointed out. But if they can move that target up to 2.5% or 3%, then they got plenty of elbow room to cut rates, to call off quantitative tightening. But of course, they will do that anyway. But it looks like they're going to do that belatedly because the data just keeps getting worse, and they keep ignoring it. Now, politically, maybe it's possible that they're trying to do this so people will blame Trump, right? They keep talking about how good things are, and that's where Trump has taken the bait and maybe fallen into the Fed's trap because he is taken so much credit for this stock market rally. He's saying the media is not giving me enough credit. Look at how high the stock market is. This is confidence in my economy. In fact, Trump is even out there talking about how fantastic the GDP numbers are going to be. He's promising a big GDP number that's going to be incredible. I mean, how can he make this promise? He can't possibly deliver that, right? I mean, unless, so why is he doing that? Are Trump advisors not telling Trump how bad the economy is? I mean, based on the data? I mean, why not just blame the weakness on your predecessor instead of pretending that everything is great, continuing that false narrative of fiction peddling so that it's all going to blow up? Because everything's great. Yep, everything's great. Fed admits, yep, the economy is great. And then the market tanks. We go into recession. Oh, what happened? Everything was great. Must be Donald Trump's fault, right? Too much deregulation, all this talk about tax cutting. I've actually started to read articles now where people are blaming the failure of Obamacare because Obamacare is collapsing everywhere, right? These companies are pulling out of the market. Some markets don't have more than one healthcare provider, and maybe some don't have any, right? And you know what they're saying now? It's because of Trump, right? Because all the uncertainty surrounding what might replace Obamacare. Is it going to be here? Is it going to be replaced? So it's all this uncertainty that is screwing it up. So in other words, it's Trump's fault. And you know what? he's going to be blamed either way. That's why they shouldn't have touched this. If they could not just repeal it and get rid of it, right? This whole repeal and replace has taken forever. And now, simply because it's taken so long and they're debating it for so long, they can blame the problems on that, right? Because if they had done nothing, if they just couldn't flat out repeal it right away, if they had, which would have been better, have the guts, flat out repeal Obamacare. But if they couldn't do that, then say, you know what, we're not repealing it, we're leaving it here. Because then at least they could blame the collapse on Trump and the Republicans for screwing up a good thing by introducing all this uncertainty. Because it's not the uncertainty that's screwing up Obamacare. It's the certainty that either Obamacare is going to stay or it's going to be replaced by something else that's almost as bad or maybe even worse. Who knows? But, this is how the media is going to continue to blame things. But I wish Trump wasn't helping them by taking this bait, by embracing these phony statistics, by embracing this bubble. I liked him better when he called it a bubble, right? When he was critical of the jobs numbers and the economic numbers. Now, of course, it's the same numbers. It's the same Department of Labor. The same people are concocting these statistics. And all of a sudden, they're no longer phony. They're great. And they prove that he is the greatest president and his policies are working. And he is going to end up regretting that. I mean, this is going to, some of these statements he'll regret, because a lot of them, too, are up there on Twitter. So they're there forever, and people can throw them right back in the president's face. Let me turn to the markets today. Another day where the Dow Jones was up, but the NASDAQ was down. We continue to see this rotation. The Dow didn't make a record high, and the NASDAQ wasn't down that much, although there were some stocks in the NASDAQ that got beaten up, mainly because of the surprise announcement that Amazon, right, the king of online retailers, is buying Whole Foods, right? And they're buying them for all cash. They're not even using their inflated stock to buy the company. They're paying with cold, hard cash, $13.7 billion of cash, which I don't think they have that just lying around in the bank. So I think they are borrowing the money, which is one of the reasons that I think S&P is saying they may downgrade Amazon's debt, because this will lever up the company. Now, of course, they could sell stock. Amazon could do a secondary offering, right? Maybe assuming Whole Foods didn't want Amazon's expensive stock, they just wanted cash. I'm sure that they could do an offering of Amazon stock and finance this with equity rather than debt. But I guess interest rates are low, and they figured, why, let's not dilute the company, even though our stock price is so high. And they're going to be borrowing money to buy this stock. But interestingly enough, the price of Amazon shares actually went up 2.5% on the day. That's kind of rare, right? Normally, when a company announces they're buying another company, the acquirer, their stock goes down. Yes, the company who got bought, Whole Foods, was up 29% on the news overnight. In fact, Whole Foods, look at the chart of Whole Foods. That stock was tanking. And it looked like it was headed a lot lower up until yesterday, until, this news came out. I bet there were a lot of people short the stock who got hammered. Now, of course, if they were short all the other retailers, they made a ton of money today, even though they lost it on Whole Foods, because even though Whole Foods, right, the whole deal to buy Whole Foods was like a $13.7 billion deal. And that's for the whole company. And so the value of Whole Foods on the announcement was up, I don't know, what the increase, the $30 bump in the price of the stock, about a 30% rather increase in the price of the stock, $10, almost a $10 jump, 30% increase. That means the additional value for Whole Foods as an enterprise, as a company, right? It went up by about, 4 or 5 billion based on that. But the net cap, the market cap of Whole Foods competitors went down. Well, I guess some of them are Amazon competitors, some of them are Whole Foods competitors. But the market caps of companies that compete with Amazon and Whole Foods, right, dropped collectively by more than $30 billion. So even though there was acquisition, and normally in a sector, right, if somebody comes in and buys a stock in a sector, the whole sector goes up that got bought, because now people start thinking, oh, this sector is undervalued. Maybe somebody else is going to get bought out. But no, this shows you how vulnerable and how weak this sector is. Everybody is scared to death. All the competitors are so afraid of this merger that even though Whole Foods got bought out, and you would think that raises the value of grocery stocks, other grocers got killed on the news. They didn't go up. And the reason for this is because people are worried that this combination is going to be very competitive, that Amazon is going to look to drive down costs at Whole Foods. And obviously this food there is expensive. It's all natural foods. It's on a higher end price point. But to the extent that Amazon could wring costs out of Whole Foods and use technology to replace human beings and become more price competitive, that is putting pressure on these other companies. I mean, take a look. I mean, Walmart today was down 4.65%. Target was down over 5%. Target is now at a new 52-week low following this news. And look at some of the grocery stores. Farmers Market was down. Spots Farmers Market down 5.4%. Kroger down over 9%. New 52-week low. This thing went over the edge of a cliff. Kroger shares now down almost 50% since peaking out in late 2015. So all these stocks were going down, and Whole Foods was one of them. All these stocks were going down, and now all of a sudden Amazon decides to save Whole Foods. That's the supermarket it's picking to buy. Now, there are people that are speculating that, somebody else is going to come in and offer more for Whole Foods because it's actually trading at a premium to the cash offer that's already on the table. So people are betting, somebody else will come in and offer more, and maybe Amazon's going to have to pay more. I don't think so. I think you would have to be a fool. I mean, there are people who are saying, well, maybe Walmart, right? Walmart will step up and buy Whole Foods. Why would they want to do that? Because if you stop Amazon from buying Whole Foods, they'll just buy somebody else, right? And then if you own one of the other, if you're Walmart and now you own Whole Foods, but now Amazon buys somebody else, what's going to happen to the new combination of Amazon and Whole Foods? The stock's going to get killed because it's just going to be another one of those stocks that's going to get hammered because they're going to be worried about competing with this new combination of Amazon and whoever they buy because somebody else was dumb enough to buy Whole Foods. I mean, if Amazon bought Whole Foods, where's the game changer there? There's nothing new there, right? So, and you also got to think about John Mackey selling out to Jeff Bezos and why he did that. I think John Mackey understands that, the competitive problem in this industry, in retailing in general, in the grocery industry. He was probably happy that Amazon picked his company, because if they would have picked one of his competitors, his stock would have been hammered today too, just like everybody else. So he got lucky, and he took all cash maybe because he doesn't know about, what's this stock worth because it's such a high multiple. But, I hope John Mackey has some influence over Jeff Bezos. He's a very, very well-known, popular libertarian CEO. He's always at Freedom Fest. Hey, by the way, if you don't have your tickets to Freedom Fest in July, go online, freedomfest.com, and register. Make sure you put my name in there somewhere so Mark Scalzo knows that I'm promoting his event, so he knows people are coming there because of me. And I got a lot of speaking engagements. There's a lot of stuff going on. We got a booth there. Some of the guys from the LA office will be out there. It's over the summer. It is hot, but we don't really go outside until it's nighttime. So the sun is down by the time we leave the hotel. Because during the day, you've got all the Freedom Fest events, and then at night, you're in Las Vegas, so you got plenty to do. So go to freedomfest.com. But I'm saying hopefully John Mackey can have some influence over Jeff Bezos politically. I'm not really sure, just move him over to the free libertarian side of things, because it'd be nice to have him joining the libertarian camp. But, a lot of the articles that I'm reading about why some of these stores should be worried, right, about this Amazon, Whole Foods combination, it's not so much the companies that should be worried, it's the employees of these companies. Because really, the advantage that Amazon is probably going to bring to Whole Foods is going to be about driving down costs through the use of technology. And Amazon's job is even easier now because governments all around the country have made labor so expensive, so overpriced, right? Because you've got increases in the minimum wage, you've got mandatory benefits, mandatory health insurance. Now, it may be mandatory leave or who knows, right? There's always some politician that wants to win votes by promising to force your boss to give you something for free, right? So all that does is it drives up the cost of labor and it drives up the advantage of substituting labor for a machine, for a computer. And that's what Amazon can do best. I already talked on this podcast about how they plan to open up these little grocery stores, Amazon Go, and eliminate the checkout. Because you no more cashiers. You just walk in, throw your stuff in a bag, take what you want off the shelf, put it in a bag, and walk right out the door. And the computer knows exactly what you bought, and it charges your Amazon account, right? Well, now obviously it's not just going to be Amazon Go. I bet they're going to have that technology at Whole Foods. A lot of people that work at Whole Foods right now, they're not going to be working there. Steve Mackey is still going to run the company. They're not changing the name. It's still going to be Whole Foods. It's not Whole Amazon or Amazon Foods. It's Whole Foods. But they're not going to have their whole workforce. I'm sure that. They're probably going to get rid of a lot of people. And a lot of their competitors are going to have to do the same thing. You want to compete with Whole Foods, and if you're a Kruger, right, you better start substituting machines for people too, right? You got to take down that labor cost because you're not going to be competitive. And they're also probably going to find some other synergies between online shopping and brick and mortar. Because, Amazon had already gotten into groceries, but it's still a small part of its business. Because I think even for most online shoppers who, buy almost all their stuff on Amazon, they probably still go to the local grocery store to do their marketing, right? Most people, especially if you're buying, produce, you want to look at it, touch it, make sure it's ripe. You're looking at cuts of meat or fish. You want it fresh. You want to look at it before you actually buy it. So a lot of people are probably, never going to migrate online. If you're buying things that, that are in boxes and staples, long-lasting things, maybe you could stop up online for some of those things, or, bathroom products, stuff like that, or detergents. But stuff you're eating and, you want fresh food, and a lot of that is not going online. So I think Bezos recognizes this, and so he wants to dominate basically retail, and he figured I can't dominate the grocery business unless I actually own some grocery stores. And maybe that's true, but you look at now that Amazon has, this huge grocery business as part of the business. What kind of multiple should the stock trade at? Shouldn't you have to discount part of their earnings now, or can the whole company now trade on this higher multiple? Is how much more valuable is Whole Foods now that Amazon owns it? Obviously the whole board at Whole Foods, not just John McKay, but he obviously other people approved this deal. They were probably all worried that if they didn't sell to Amazon, somebody else would, and obviously their stock would have tanked, right? So they almost had to sell to Amazon, because everybody who didn't sell to Amazon is going to get killed. So it's like you have no choice, right? It's a gun to your head. Either you let me buy you, or I'm going to buy one of your competitors, and then you're worthless, right? So obviously they knew the business was in trouble. So how much is it worth now that Amazon owns it? Now, it's probably worth more than their competitors that don't have this advantage or the synergies that Amazon might bring to the table, but we'll see. The stock was up today. I don't know if people are going to start to question this story, because it's almost ironic, right? Because first, Amazon basically puts out of business all the bookstores, and it's putting out of business all sorts of online retailers, right? It's retail apocalypse. This is the worst year for retailing probably ever. It's not all due to Amazon. Amazon is part of it, but yes, they helped put out of business all these companies, and now they're trying to become what they destroyed, right? They're starting to buy up some of the businesses that they're driving out of business because of the relative advantages they've been able to generate through the online shopping experience. But I guess one of the reasons they can afford to buy the companies is because they've driven down the price, and because their stock price is so high. Although this deal is not a stock deal, it is a cash deal. But one of the reasons that they can borrow this much money is because obviously the stock valuation is so high that the debt level relative to the stock is still very small. But of course, there is the chance that the stock price could fall. And so, but who knows? As I said, the company may eventually launch a share offering of stock, and then they can easily pay for it based on and the value of the stock. And the dilution wouldn't actually be that big. I mean, what the market cap of Amazon is enormous, relative to what was just paid for, what they just paid for Whole Foods. But my point is, who should be worried? It's not, maybe the stockholders, or I guess they could be worried, but the employees. People are going to lose their jobs. And a lot of these are these guys, these minimum wage guys, they're striking for $15 an hour minimum wage, right? They want to force their employers to pay all this money for these unskilled jobs. What they're doing is they are eliminating their jobs. They are pricing themselves out of the market because they are making it more attractive for these companies to automate. And in fact, even if they were resisting it, Amazon is going to leave them no choice. Because if Amazon is driving down prices at Whole Foods, and now more people are going to Whole Foods because they've got a better price, then their competitors are going to have to copy at Whole Foods, and they're going to have to find similar ways to drive down prices, and that might mean letting go of workers. And of course, under normal circumstances, right? If this is a total free market, if the government wasn't distorting the labor market with all these mandates and all these minimum wages, right, and all these taxes and healthcare, we had a regular free market. And businesses were substituting machines for people, it would be a good thing. It would be pure progress. It would be a win. Even for the people who were losing their jobs, they would still be better off over time based on that natural improvement in efficiency and productivity, based on greater abundance that would produce rising living standards. But when you have a situation like we have today, and businesses are substituting capital for labor, not because the free market would move in that direction, but because government has artificially inflated the cost of hiring people such that technology is now cheaper, not naturally, not based on its own, not based on how the free market would allocate resources, but based on how the free market is trying to allocate resources in an environment where the government has interfered and made labor artificially expensive. So now the substitute to capital is not something that the free market wants. It is not the most effective use of our resources. It's only the most effective use given the artificial constraints that government has placed on labor by making its price artificially high. And now, once the government has done that, once the government has screwed up and artificially increased the cost of labor, then substituting capital for labor in that circumstance is an improvement for the overall economy, but now you've trapped certain people in unemployment who wouldn't be trapped in unemployment because in a free market, to the extent that there were still people ready, willing, and able to work, they would have their jobs. But what would happen in a free market is at some point you couldn't find people that would be willing to work for the low enough wage, and so you would need to use a machine because people wouldn't take the job. Because in most circumstances, people prefer interaction with a human. I mean, almost every circumstance that I have in my life, right? I mean, if I can talk to a human, I'm talking to a human, right? I mean, when I'm calling a company, I mean, I'm always, the first thing I do is I hit zero, agent, operator. I mean, I want to go right to a person. I don't want to be stuck in a maze of voicemail. I mean, most people, hey, if self-serve gas was the same price as full-serve gas, would you pump it yourself or would you let the gas station attendant pump it, right? Most people prefer to have somebody else pump their gas. So you rather do it yourself than use a machine. You use the machine because the machine is cheaper, but people interact with other people. But when the government comes in and has an artificial price on labor, well, then, you don't have the real market. Oh, another, example of this I had, I just went into the city the other day, and I actually went in by train, so I bought a ticket. And when I was at Grand Central Station, there's this huge line, right, of ticket windows, probably 15 or 20. And there's only one human being there. And there's a pretty long line. But I didn't wait it because I decided to go, to the other end of the station where they have a bunch of machines. And, I just bought my ticket with a machine, and that was fine. But, if there was a human being in enough of those windows so that there wasn't a line, I would just assume go to a human being, buy a ticket, pay the human being, let the human being, take my credit card or whatever. I'd rather do that. But I didn't want to wait in line because they only had one person at the window. Why? Because it's so expensive to hire all those human beings. So it's cheaper to use these machines. But there's so many unemployed people, so many young people that don't have jobs, that aren't even working. If you got rid of all the wage laws, got rid of all these mandates, I bet there'd be a young kid at every one of those windows learning job skills, right? And people would use them. But the government makes that choice too uneconomical. So there is a substitution of humans for labor, but it's not necessarily market driven. If it is market driven, then it's good. When it's not market driven, then it could have very bad consequences. Like people are being put out of work and there is no other job waiting for them. They're trapped in unemployment because of these laws. So you got all these people out there that are so excited and so happy. I demand $15 wage. We want more money. We want more money. And what ends up happening? They get no money, right? Oh, this job doesn't pay enough. Okay, you're right. Now the job doesn't exist. Yeah. Oh, I can't raise my family on this $12 an hour. I need 15. Well, you know what? You want to, this job, you're right. This job is not for somebody who wants to raise a family, so we're going to eliminate it. We're going to give the job to a computer because the computer doesn't have a family. So it's perfect, right? If the job doesn't pay enough to support a family, then let's have a robot do it, right? But this is what's going on, and this is why a lot of these stores are getting killed, plus the retailers in general, because Americans are broke, right? The Federal Reserve doesn't want to acknowledge it, but the economy is a mess. Consumers are in bad straits. They're loaded up with debt. The Fed's making that debt more expensive for them to service. They have lousy jobs, if they have any jobs at all, or they have multiple lousy jobs. They got credit card debt. They got auto debt. They got student loans. If they still have a house, a lot of people now are renting and their rent keeps going up. But if they still have a house, unless you're in a few of the bubble areas of the country, you've got no home equity either. Meanwhile, looking at what's happening in the dollar continued to trend lower again today on the weak economic data. Dollar index still above 97, but just barely closed at 97.14. Remember, the low before we had the hawkish hike, the unexpected hawkish hike on Wednesday was below 9. I think we got down to 96.30. So the dollar did have a rise, but given how hawkish the Fed was, and given the possibility that QE, quantitative tightening, is right around the corner, I'd say the dollar is acting very weak, and I'd say the opposite about gold. I mean, gold today was relatively flat. It barely was down. It was only down about $6 or so on the hawkish hike. It was down, I think, 5 or 6 the next day. I mean, very little because it was up, going into it. So I think for just having had a rate hike and for the Fed to have surprised the markets with we're about to do quantitative tightening, the fact that the dollar isn't stronger, the fact that gold isn't weaker is a very, very good sign that the dollar's going down and gold's going up.